And for those of you who don't know, I'll let Mike kind of introduce himself, but we've got Mike Howler with us with the Howler Group. He is actually Bliss's accountant, and he's actually my accountant, and he's awesome. And he specializes actually in real estate, taxes and stuff for realtors. So I will let him tell you more about himself, but if you are looking for an accountant, he is awesome.
Well, that's so nice. Thank you for that. I appreciate it. Sorry, I have my screen blackened out. It's tax planning season in my office, like most accountants this time of year, is pretty chaotic. So, so I didn't want to really show that. I guess I could put a background on, but that's all right. So, you guys want to talk about tax planning a little bit and some of the strategies for this year and just some of the changes possibly or that have come about. And there's a lot that could still be in the works, but we won't get into that because it's, you know, who knows what will happen. But some of the bigger things that happened this year, like specifically one as it relates to inflation, would be the mileage reimbursement rate. So it went from, so the first half of the year, as you're calculating your mileage, it is 58.5 cents per mile that you get as the mileage rate. The second half of the year, starting July 1st, it bumped all the way up to 62.5%. So, so that's something to, as you're putting together your deductions for the year, to make sure that you are separating them from the first half to the second half. That extra 4 cents, and it doesn't seem like a lot, but it'll add up, especially with, you know, the industry you guys are in, and you guys do a ton of driving. So another one, and you guys probably deal with this quite a bit with clients and whatnot, but solar, the federal solar credit. So over the last couple of years, it had been going down from 30% to 26%, and it was supposed to be at 22% this year. But Congress, I think it was in the one of the recent bills that Joe Manchin introduced in the Senate. Anyways, it passed, and now the solar credit is back up to 30%. 30% federal tax credit for this year and for next year. So that's been baked in, and the state of Arizona also has $1,000 credit on solar if you or your clients or whatever wanted to go that route. So it is a great tax credit. I'm not saying that it should be used, but it's one if you just don't want to pay any taxes. That's a big one. There are various like renewable energy product credits that are coming out, you know, that they've had for every year, basically, where you could get up to a $500 credit. It depends on the price of that you've paid for. It could be energy efficient air conditioning unit or appliances, or even sunshades on your home, on your home windows. So they do have credits that are available there as well. Let's see, the Arizona tax credits. I don't know how familiar you guys are with those. Some accountants push them, some don't. I push these a lot. There's generally 5 credits that virtually anybody can give to. One is the qualified foster care organization. So if you are married filing jointly, you could give $1,000 a year as a couple, and that would be $1,000 off your Arizona tax liability. If you're single, it's cut in half to $500. We also have the qualified charitable organization thing, which is a lot, and there's, I don't know, maybe 25 pages of very small print of organizations in the state that would qualify for this, but a lot of it is food banks and you name it. I mean, there's just a lot of different things on there, but you could give married filing jointly $800 to it. And you could also give $400 if you're filing single. The public school credit is you can give to any public or even charter schools that are public. That's $400 if you're married filing jointly, and $200 if filing separate. And then there is it's the private school tuition organization. This year, the total is now over $2,400 that a couple could give married filing jointly. And then it's cut to a little over $1,200 if you're filing single. The last one I push a lot is it's called the Arizona Military Family Relief Fund. And it's the same amounts as the public school credit. It's $400 for married filing jointly and $200 for filing single. And that one has to be done through the Arizona Department of Veterans Affairs. The reason I'm a big pusher of the tax credits is that you get to direct your tax dollars to something that's charitable, worthwhile, and instead of it just going into the government general fund, and who knows what they use it for, but you get to direct it how you want to do it. So it doesn't save you any money on taxes, but it just allows you to direct it. The only way that it would save you on taxes, there is one way. The way that it would save you on taxes would be what's called the state and local tax limitation. So if you itemize your on your personal income tax return, so you're able to write off your medical expense, your charitable donations, your state and local taxes, which is limited to $10,000, and your mortgage interest, if you have enough deductions and you're able to take that, the way that these credits come in to help lower your federal tax even more is they qualify as the charitable contributions on the federal side. So, and the limitation on that is 60% of your income. Most people never get anywhere close to that, so you don't reach a limit there. But your state and local tax limit that the IRS caps you at is $10,000. So if you were to pay between property tax and state income tax and your vehicle license taxes and all that, when you add that up in a year and you're at $10,500 in deduction there, the IRS is only going to allow you to take $10,000. So a way to get around that is if you do these state tax credits, you could still be at that 10,000 or close to, but then you've got the rest of it going into charitable contributions, which then increases your itemized deductions. It's kind of a complicated matter here, but that's, to me, is I always default to giving to the credits, because you're not likely to max that out for the year. And so it's just going to give you more opportunity for deductions all around on your return, both federal and state. So this year, I know I get a lot from realtors of, should I go buy a new vehicle this year? This, I will say, it's been I guess since the Tax Cuts and Jobs Act that President Trump passed at the end of 2017, he enacted something. There was 100% bonus depreciation is what it is. And it's going away after this year. What that means is if you were to buy an $80,000 SUV for your business, for you to work on your business, and you were to drive it 100% of the time for business, you could essentially write the whole thing off in 1 year. And then it would make $80,000 plus whatever other vehicle expense you had for the year, was like gas and repairs and tires and who knows what, washes, oil changes. All that stuff would be deductible in 1 year. It would dramatically lower your taxable income. But that is going away after this year. So you won't be able to depreciate a vehicle completely in 1 year. as you have been the last 5 years or so. So what it will look like going forward was there was something called the Section 179 depreciation, where you could take $25,000 on a vehicle that met the gross vehicle weight rating of 6,000 pounds or more. You could do the 25,000 depreciation deduction, plus then part of the truck over that'd be spread over 5 years. So maybe if it was an $80,000 truck, you're really looking at then maybe another 11,000 on top of it. So instead of being able to deduct 80,000 in 1 year, the most you'd be able to deduct is probably about 36,000 starting next. Then that'll start in 2023. I don't anticipate them allowing 100% depreciation to continue to move forward into future years. I think they're going to allow this law to sunset. So if you're looking for an expensive SUV or truck or whatever, this is the year to do it. If you want the big deduction, you'd have to do it before year's end. So
Hey, Mike, Terry
yeah.
was asking in the chat, and you might need to expand on what qualifies for that deduction, because she's saying that the car she bought 3 weeks ago was a good thing, but you might need to expand, because I think they have to be a certain weight, right?
Yeah, I mean, Terry, can you expand on what kind of vehicle you purchased?
Yeah, it is an SUV. It was a Hyundai Palisade.
Okay, do you know the Hyundai Palisade? Let's see here.
It's a 3-row. I'm not sure what it needs to be.
Does they have to be, is it 6,000 pounds or 8,000?
Yeah, I'm just looking it up right now to see what it is. So, okay. Yeah, that's not going to meet the.
Damn it.
That's going to be below. So, yeah. So you'll be able to depreciate that over 5 years.
Okay, got it.
Able to do. So you'll still be able to depreciate it. It's just you're not going to be able to write the whole thing off in 1 year. So
all right. Well, I got excited and there it goes. So
you missed it by 129 pounds. So
but I weigh more than 129 pounds. So when I'm in it.
Yeah.
All right. Thank you. And thanks for calling that out, Lisa. I appreciate it.
Yeah, thank you.
And is the weight 6,000 or is it 8,000? I can never remember.
6,000.
Okay,
6,
that's what I thought.
Yeah,
Okay.
and if you're looking for a specific vehicle and you don't know, you can literally type in what there's lists all over the internet of what the IRS approved vehicles are, for the deduction, which ones come at 6,000 pounds or not, and they'll have it by make and model and all that stuff. So it's pretty easy to find online. So. And if you have any questions, you can always email me and I can send you the list if you can't find it, if that's something you're interested in. So
thank you.
Yeah, of course. Let's see here. Let's talk about, I'm going to talk a little bit more about the vehicle expense, because there's so many different ways to go about it. People either, lease a car, or they'll lease it, or they're wondering if they should buy, or should they keep the car that they currently have? What's the best thing for tax purposes, and particularly in this economic climate? I personally am not a big, right now, I'm personally not a big believer in just going out to buy a vehicle. I think they're still a little overpriced. I know the market's been coming down on the vehicles, but I still think that they're overpriced. And in a couple of years from now, you might be way upside down on that vehicle. And while you may have gotten some tax benefits out of it, I just not sure that it would have been the best financial decision all around, unless you can wait into next year, when I think the market's going to come down, quite a bit more on vehicles. So if you can wait, that would be a better time, in my opinion. A lot of people in your industry, you guys, I do have some people who like to lease their vehicle, but they don't really know what the difference is and how you deduct that. So I wanted to talk about that. So when you lease a vehicle, you can write off the portion of the payment. It's the only way you can write off a portion of the payment. is if you lease, and you could write that off. So you still have to track your mileage. So whatever your business mileage is to your total mileage, and then that percentage you get to write off. Along with, you also get to write off whatever insurance you have on the vehicle, the your washes, your oil changes, any repairs or maintenance that you have on the vehicle, insurance, everything like that. So your deduction can add up on it. You won't get the mileage deduction, even though you do track your mileage, but it's just another way to do vehicle deductions if you are one who likes to get a newer vehicle on a pretty regular basis every 2 to 3 years or something. So I don't recommend, if you're somebody who wants to keep churning vehicles, of buying expensive SUVs and just trying to take the depreciation going back and forth on these things, because eventually, if you haven't kept the vehicle long enough, you're going to have to recapture depreciation that you took on a vehicle. So if you accelerated depreciation on one and took it all in one vehicle and took it all in 1 year, like let's go back to the $80,000 SUV example, and you took that all in 1 year, and 2 years later now you want to trade that in and get something else, well, some of that depreciation is going to come back to you and be taxed as income at 25% taxation. So you want to be very careful about that and talk to your tax advisor when you're making a decision on what kind of vehicle and how you want to purchase it, and looking at your vehicle, how long you keep your vehicle, what your personal history is on that. That you really need to take that stuff into account, because sometimes it seems like a really good tax savings tool at the beginning, but it could come back and bite you later. And it might bite you in a year when, oh, my sales are down, I don't have as many commission income, and now my taxes are up, and I wasn't counting on getting this recaptured depreciation as income. So you just got to be very careful about that. So does anybody have any other questions on automobile stuff? No? Okay. Let's talk about.
Actually, I had a question really fast.
Sure.
To like write off our lease payments, do we just submit like our statement
Submit a statement to where?
to our tax person?
Yeah, you can total up your payments on it. You can just total that up and say, these are the payments that I made on it, and then here's all my other expenses on it. So whether you had gas or whatever, and then you'll have to give them, what your total business miles were and your just total overall miles, and then they'll calculate what part of all of that deduction you get to take.
Okay.
Does that make sense?
Yeah, and then
Okay.
just like save receipts and stuff too.
Yes, you all are self-employed or business owners, so you have to keep business receipts. And I'm sure a lot of you have heard about the IRS and these potential 87,000 new auditors that they're going to try to hire. You definitely want to keep your receipts for that, because credit card and bank statements don't matter in an audit. If you do not have a receipt for it, the IRS can legally say, nope, it's not an expense. So you got to keep every receipt. There's a lot of online, lots of scanners. You can scan things in, and I'm a big believer in that stuff, because a lot of receipts will fade and you can't make heads or tails of any of it over time. So if you can scan them in, that's a great thing. But if you want the deduction, you got to keep your receipts. So especially if they hire these 87,000 agents, because we're looking, if they just dispersed it by population, that would be 1,917 new IRS auditors just in the state of Arizona. That's a lot. That's an incredible amount. That's more than double the size of the IRS workforce in the state of Arizona right now. So it would be a lot. But
Yeah. Does anybody need, I just I was just introduced to a free app that you can use to do receipts. Scan your receipts and track them and all of that stuff. If anybody wants to know what that is, I can hit it in the chat.
okay. Does anybody have any specific questions on any item that you just may have a question about or not? I mean, that I don't know about. I just want to make sure I'm answering your guys' questions.
I actually
What do
have
you-
one more, if
Sure.
I may. I was told by another agent that her tax attorney, speaking of saving receipts, or her tax advisor told her that if she needs to save every single receipt because she's able to write off all sales tax being a business owner. Is that correct? No matter what the expense?
She can, yes, but yes, and so if you take your expense down that granular and you're tracking all the sales tax, yes, you can write that off. But a lot of times you're just adding up whatever the bottom line of the receipt says. So you're including the tax in whatever. So if you bought a new laptop and it was $1,100, but with tax, it's, you know, $1,230 or whatever it is, you're probably using that $1,230 figure anyways. So
Right.
you are deducting it, and that's how I don't think I have anybody who does it where they separate out the sales tax. So, and the IRS isn't gonna, they're not gonna worry about that.
So what, I have a folder that I keep all of my business expenses in.
Mhm.
And then I have a separate folder that I keep just every single receipt in that's not a business expense for the sales tax purpose of it. Is that something I need to continue to do? So when I list all my business expenses, it's the bottom line, but then everything other than business expense, I'm just saving those for tax, sales tax. Is that right?
Well, yeah, so all your individual receipts is what you're talking about, then not just the business receipt. You're talking all your individual receipts that you have for, even if you were to go to the grocery store and buy some,
Exactly.
you know, non-food items. All that sales tax is deductible if you want to take the time to go calculate it.
Okay.
Otherwise, they're gonna go ahead and give you a calculation. It's already gonna estimate a calculation for you, if you just don't want to be that detailed on it. It's a lot of
Okay.
work. I do have one client, she does do it, but she admits it takes her like the better part of an entire day to go through all of her receipts just to calculate that. So
Okay,
it's a lot
gotcha.
of work. So it's just a
Yeah.
matter of that, if you
Well,
want to do that.
I have 2 kids and they are perfectly bored, so I don't mind putting them to work.
Okay, well, there you go.
Thank you.
Yeah. Does anybody, if you
Yeah.
don't mind speaking up on this, does anybody have a spouse who helps them in their business? Nope.
I do actually, yeah.
Occasionally,
What's that?
I said occasionally. He's
Okay.
my guy.
I mean, he stays home with the kids when I'm working. Does that count?
Well, I'm just gonna, I'll mention something, and Lisa, I think I talked to you about this before in the past, but there is a plan. It's called a health reimbursement arrangement, an HRA plan. It's under Internal Revenue Code Section 105. If you are a sole proprietor or you are taxed as a C Corp, and these are the only 2 entities you could do it in, your business can hire your spouse, and when your spouse works in the business, you don't actually have to pay them wages. You reimburse your spouse for their payment is basically a reimbursement of all the out-of-pocket medical expense for the family, up to, you know, whatever their hourly rate times their number of hours, whatever, and you put a cap on the plan, so maybe it doesn't go above 10 to 15,000 or something like that. But then you're turning your out-of-pocket medical expenses, instead of them being itemized deductions where, given the current state of the tax law, they're almost, medical expenses are almost never deductible anymore. I mean, very rarely does any of it show up as deduction. Now they are business deductions, and that helps lower your income tax in a much, much better way. So if you do find yourself in that situation, or if your spouse wants to be more involved, there can be a creative way. And let's say you're the real estate agent, obviously, but then your spouse works for Intel, so to speak, and you get your health insurance through Intel. And so even the health insurance premiums that they pay, their portion of it that they pay out of their paycheck, would be a business expense to you in your business. Pretty cool. So there's a lot of, little things like that in the tax code, but this is a good one that I like to talk to people about, because most don't know about it. So
Hey, I had a quick question about the
Sure.
receipts.
Yeah.
What about something that, like an online order or something like that? Would you scan the order confirmation, or how does that work?
Yeah, I mean, you should have a receipt or something. You usually get emailed a receipt or some kind of confirmation
Okay.
showing
Yeah,
that
the
you paid
confirmation.
that
Okay,
money
so
for it.
print those out.
Yeah, just
Okay.
print it to a PDF and save it, So
Okay, awesome,
yeah.
thank you.
Yep. And you'll be amazed when you start keeping your receipts, you're going to find that you were missing a lot of expenses in the past, most likely. So it's good to do that. And go through it once a month. And when you tally it up once a month, you're going to be, incredibly accurate on your stuff. And you're going to realize, yeah, I probably had 5,000 or 6,000 more in deduction than I would have had if I'm just trying to scramble at the end of the year. It's really without fail that people who start doing it on a monthly basis, when they were just doing it annually, always find several thousand more in deductions. So.
Speaking of deductions, then when we hire a tax professional, that expense is also tax deductible. Is that right?
It is part of it. I mean, I deduct it. I use it I deduct it for my clients, and I use it as it's a professional fee, so, and that's what it is. So some accountants just put it as tax preparation fee, and tax preparation fee is not really deductible anymore even if you itemize your deductions. But for me, it's like I'm going through the process of it's all work for your business to determine the compliance of your legal compliance of your business and all that. So I can make a very strong case that it is a business deduction. So, because what you are doing when you're filing a tax return, yeah, we're accountants, so to speak, like we are, but we work in the law. Everything that we do is law-based. It is not, we're not just doing bookkeeping or whatever. Like this is federal and state law that we're working with, and we have to understand the law and be able to be in compliance with it. So it's really legal work with numbers is really what we're doing. So
Awesome. And then
Yeah.
one other question then for marketing, and you may be getting to this, I'm sorry if I'm jumping ahead. For our marketing, let's say closing gifts. I know that there's only a certain amount that you can write off for closing gifts, like $25 or something,
Correct.
unless it's branded. Is that right? If we brand it, it's
well, here's what I like. If you're gonna do gifts or something like that, like I would, do a gift. That's fine, and keep it to the $25 or whatnot. But then what I would do is a promotional thing. And maybe it's a referral program, and you do a promotion and you give them I have an agent who on every closing she gives a bottle of Dom Perignon with their name on it, and their name is on the box, I think is what it is, something like that. But that's what she gives. But the way that the box is presented, it's really a promotional thing. And even on the champagne itself, it's far more promotional. She pays a pretty good amount for it, but it's all very promotional. And she goes to then celebrate it with them and their family and all that stuff when they're, and this is when they have like a housewarming thing. And then it's her way of marketing herself. So it is promotion at that point. But she
Awesome.
does do a gift, or she'll do a $25 gift card to the to one spouse and another $25 gift to the other spouse, and that's how she'll do it. And she usually does that by gift cards, and then she'll do the thing where she's like, "Hey, invite me over like a month after," and then that's where she comes over after they've settled in, and she comes over with that, and that's a promotional thing. And then now she gets to meet some of the family members and whatnot, and then. So she doesn't spend any money on marketing. It's just the promotional stuff, so, and you could do that. So, or I should say she doesn't spend any money on advertising. Let's say that.
Okay.
But she does on that. And she just gets referral after referral that way.
And how does she prove that she markets it in such a way to call it promotional versus?
She takes pictures of it.
Okay,
Yeah.
awesome.
Yeah.
Okay, thank you.
Yeah, absolutely. Anybody else have any like specific questions? Let me ask, how many people, if you can just speak aloud, like how many people have an S Corp? No one? Wow, okay. Has anybody talked to you guys about having an S Corp? Or what the benefits of it are? Let me say this. I'm gonna assume you all are taxed as sole proprietors. And if that's the case, the way you guys are taxed is every net dollar that you get from your business, you're going to pay 4 taxes on. You're going to pay state income tax, federal income tax, Social Security tax, and Medicare tax. Those are a given that you will pay. So when you look at the federal side, you're going to pay 15.3% in your Social Security and Medicare part. Half of that 15.3 is you as the employee, the other half is you as the employer. So you're paying 15.3% on it no matter what. Then whatever your federal income tax rate, you're going to add that on top. So if you're in the 22% bracket, now your 22 plus 15.3, your real rate, federal rate, is 37.3%. Then in the state, if you add in say you're at the 3.5, well, now you're getting close to 40% there as your overall tax bracket. So 40 cents on every net dollar that you earn is going to go to the government.
Gross.
So yeah, it's it surprises people every year when I get it, when I have to explain that to them if they're a new client, and I explain them like, yeah, you're taxed kind of the worst way. So the S Corp is, if you're going to make anywhere from 70 grand or more a year, is really the break point of what I say, is then it makes more sense to be an S Corp, in my opinion. From working with an accountant perspective, if you are an S Corp, it's going to cost you between $4,000 to $5,000 a year working with an accountant to do payroll and the tax return and the tax planning and different tax plans that you legally, one you must have, another one you'd be crazy not to have it. It's going to cost about $4,000 to $5,000 a year just from an accountant compliance standpoint to operate that. It's far more expensive to operate an S corporation, but it will save you an incredible amount in tax. It's just a matter of what's that break point, right? You're either going to pay it to the accountant or you're going to pay it to the IRS. To you, it doesn't really matter. What you're looking for is what saves you the most money out of pocket altogether.
What's the cost incurred with setting up an S corp? Is there some kind of a standard amount that it costs to do
It
that?
usually costs about $1,000 with an attorney to set that up. You want to set it up the right way. I mean, I have people who try to do it, and then if you try to do it on your own, I guarantee you're not going to get it right. I can
tell you, I wouldn't get it right.
you will nowhere near get it right.
I can barely make a
And
shopping
then it
list.
will cost you about 50% more than it should have to just fix it, to have an attorney fix it. So it's better to just have the attorney do it the right way. But there's a lot of money that can be saved through that. So it's just a matter of, like I say, is if you're going to average 70,000 or more per year, it makes more sense to do that. If you're not going to average 70,000 or more, and then it's better to just stay as a sole proprietor, in my opinion. So, because there is more work on your end to do as an S corp. So it's got to not just be a matter of a financial savings. It's got to also be, you also got to factor in the time that it takes to do different things. So, but there are some specific tools that go with an S corp. Is one thing is you're required to pay yourself a wage. Where the S corp separates from the sole proprietor is that you only pay Social Security and Medicare tax on the amount of money that we allocate as wages. So let's say your income for your business was $100,000 gross. After all expenses, you would have in your sole proprietor business, let's say you're left at $70,000, okay? $70,000 times 15.3%, you're going to pay $10,710 to the Social Security and Medicare accounts. That's it. I mean, that's a given. And then you're going to pay federal income tax on top of it. Now, let's say you did an S corp, and let's say we allocated only 30,000 of that to wages, or 35, right? Right there
We can choose
alone.
what wage we would pay ourselves.
That would be a way, yeah, we would do the pay, your accountant would do the payroll for you. They'd figure out your payroll annually based on whatever your expenses are. And the goal is to use different tools in the S corp that are only available to the S corp or C corp, but definitely, and you don't want to be a C corp. So let's just throw that one out. That's double taxation.
Oh,
So in the S corp, the idea there is to get your income as low as possible, your taxable income, using some tax tools, like what's called one of them is a dwelling use rental plan. This is a plan that's available to S corps and C corps, but it allows your corporation to rent your home for up to 14 days a year. Your corporation, then your S corp, pays you the rent. And I have almost every one of my realtors does this. And you can, in your 14 meetings a year, they're just board meetings with you, and you're just, working on your business, not working in it. So you're not working on client stuff. You're working on how you grow your business, your financials, your marketing plan, whatever the heck it is.
this meeting type.
Whatever regulatory things are out there that you're trying to do. It's just, you're researching different things. You might be looking at retirement plan options, whatever it is, different CRM tools. I mean, whatever you're doing, but it's working on your business. So like an online quote that I find in this area is like $150 an hour. And you do these meetings 8 hours a day, 14 days a year. That's a $16,800 deduction that will show up as a rent deduction on your S corporation. And all you're doing is just transferring that money from your business account to your personal account. It's going to not be taxed at all. You just gave yourself $16,800 free by doing this plan. So that lowers, now you had 100,000 in income, right? Now we add that 16,008 into there. So now you're down 83,000, you're down to, under $84,000 taxable. Then we put the rest of your expenses in. And now you're closer to 50,000 than you were to 70,000. And then of that 50,000, we're taking about 40 to 50% of it and only allocating that to wages. So instead of having $70,000 taxed at 15.3%, you might only have 25,000 taxed. So
But
when you look at
Mike,
that-
isn't that rental income just taxable as personal income if you've rented your house out?
It is not. Under Internal Revenue Code 280 AG, and it's called the Augusta Rule, which you can find online. The Augusta Rule it's from, if anybody is here familiar with golf, the Masters is in Augusta, Georgia. And where this happens is, so there's a carve out in the tax law that says you can rent your home, and any of you can do this. You could do this now. You could just decide, hey, the Super Bowl's coming here. I want to rent my home out to some NFL player or whatever, or some ESPN analyst or whatever I'm going to rent it out for 14 days. Say you charge 20 grand a month or a week for it. And as long as it's not more than 14 days, and you got 20 grand for each week for 2 weeks, that 40 grand that you would make is not reportable on your tax return.
But it's only deductible on an S corp.
Well,
Let's see.
no, I'm just talking now, this thing, let me step back. So I'm just telling you, like, this is a personal thing you could do. Is you could do this thing, you could do this in your own home. You don't have to do this on your business. I'm just saying you could do this in your own home. And you don't have to have a plan or anything like that to do it. But if you did that in your own home and rented it out and said, oh, I'm going to go live in a hotel for 2 weeks and I'll pay, what, 4 grand, whatever it is. But then you're going to rent your home out and make some money on it. You don't have to report that. That the carve out in the tax law, that's the Augusta Rule there. But they did another carve out in the tax law that allows an S corp or C corp. They are a separate legal entity than you are. They have their own tax ID number. They're an incorporated entity. Those entities can rent your home for 14 days. They're private. The money that the S corp pays you is tax-free because it's 14 days or less. So it's a pretty cool tool that, I mean, nearly all of my S corps do. The only ones who don't do it are just because they don't make that much. They make some money doing it, but they also just don't want to be bothered by doing things, to be honest, because you have to create your own meeting agenda and meeting minutes, which we have the templates for. We create the legal plan for and all that. And then it's a really, really great tax savings tool. So
If you don't have an S corp, but you have multiple LLC rental properties, can you also have your owners meetings for up to 14 days a year and write all that off?
no, because they're not S corps.
I see. Okay.
They have to be incorporated.
And if you formulate an S corp, it's not really valid unless you're paying out payroll.
You have to pay out payroll and you have to pay a reasonable salary that the IRS has it in the tax law. It says reasonable salary, even though they don't define what reasonable is. So a lot of
Sounds like
times,
government.
yeah, it's a government. Yeah. And I worked in Congress for 10 years. So I understand, I can read the tax law and know it better than probably any accountant here, to be honest, because I used to write it and I used to read it all the time. So I know it really, really well. It changes a lot. So there's about 3,000 to 3,600 changes per year to tax law, and most people don't even really know that. It's impossible to keep up with. It really is. So but in our areas of what we do, we try to stay up on it as obviously as much as we can. But yeah,
Jay,
these are just
thanks,
some of
Mike.
the highlights. These are some of the big things that you could do that are, I'm bigger on how do we design a tax structure for each individual client that best fits their own needs and what their want is. And our goal is to help you pay as little in income tax or even payroll tax. So as little in tax possible and help you then grow your net worth. So we're a big believer in trying to use different retirement plans, and there's some long-term tax-free insurance investing things that you could do that's outside the market. There's lots of different ways. I'll just spend a minute on this, and I know we're coming to a close here, but this tax-free wealth thing is an insurance scam. I'm not a big guy on insurance, to be honest with you, not on like whole life and all that stuff. I just think usually the returns on those suck. It's okay to have some basic coverage and providing for needs and family members and that kind of stuff in case of something tragic happening. But there is this one, it's called this Kaizen strategy, and it's a life insurance deal, but you basically put money into it, one payment a year for 5 years. And then you wait about 15 years, and then you could start taking it out. And all the money that you take out of it every year in retirement, because you're just taking a loan against your own policy, is completely and utterly tax-free, doesn't show up on your tax return at all. Nothing. So there is a guy out there, and I think you can Google search. If anybody's familiar with college football or NFL football or whatever, you've probably heard of the name Jim Harbaugh. Anyways, he is the head coach of the Michigan Wolverines. Well, when he was with, I don't know what, I can't remember where he was at the time, but anyways, his financial advisor told him about this strategy. And so he's out, he talks about it a lot. It's great because he put in so much money a year for 5 years and never had to put another dime in, never had to do anything. And starting, I think it was last year, he's now pulling out, now he put a lot of money in, don't get me wrong, but he's pulling out 1.2 million a year on top of his $9 or $10 million a year salary that he gets from being the head coach of Michigan. But he's pulling 1.2 million a year until he dies. And then when he dies, he's still going to have a huge cash death benefit in there. It's insane. I just did one, I just showed a lady in here 2 days ago. She's interested in putting 50 grand a year into one over the next 50 grand a year for 5 years. So that's 250 grand. She's 42 years old. In retirement, when she turns 65, she'll be able to pull just shy of $140,000 a year that won't pay any tax, no federal, state, well, nothing. 140 grand a year. She could take it just as a monthly check. And she'll take that from 65 through age 90. And at age 90, there's still a death benefit of 1.9 million to her beneficiaries. Pretty crazy. So there's lots of different things. We're always constantly looking for new ways to basically screw the IRS legally. So it's how do we help you build wealth, and how do you just keep as much money in your pocket as possible? So anyways.
Awesome. That's awesome. Thank you for all of this information.
Sure. Happy to help.
Is it too late in the year? So if I wanted to establish an S corp, is it a good idea to do that now so that we can use it for taxes when we do them in the spring? Or is it best to just, does it start with next year?
Did you have a PLLC set up this year?
No.
No. Okay. Then I would say it's way too late, because you have to do it by May 5th or March 15th of the year you're going to do it. So, but I would, if you want to do it, I would, the attorney I recommend highly is Mike Abel with Abel Law Group. He's in Gilbert, and he's fantastic. And he is a tremendous real estate attorney as well. So any kinds of real estate issues or anything like that, he's phenomenal, but he is great at setting up PLLCs. And he'd be a really great resource for any of you guys as you come up with issues, but he can help you set that up. I work really closely with him. And, but you would want that to take effect on January 1st of next year.
Okay,
It's
got
just
it.
too late for this year. So,
Thank you. And thanks for the referral.
yeah, absolutely. So. Anything else? Okay, well, you guys have my email, it's here in the chat, and if you guys need anything, just, shoot me an email or give me a call and be happy to chat with you guys.
Oh, could I get the name of the thing where you pay your insurance that you just went over? I didn't write it down.
Oh, it's Kaizen, Kaizen.
Okay.
You have my email there. If you want to email me, I'll send you a link.
Okay.
With some information on it, and then yeah, then you could, and if it is something that you're interested in, then I can go ahead and send you to a guy here who's now there's a ton of financial advisors in the Valley. Financial advisors are I don't know, they're a dime a dozen, and quite honestly, most of them don't know a whole lot of anything. They're just really salesmen, to be honest with you. But the guy that I work with, he's in Scottsdale. His name is Denver Nowitz. He's an investment manager. He is a money manager. He is phenomenal. And he's probably the nicest individual you'll ever meet. He's just so nice, and he's so knowledgeable and so good that I just bend over backwards to refer people to him. But he's one who does the Kaizen strategy and stands by it, and he's tried to break it every way possible, and he can't break it. And this guy is highly intelligent. We've gone back and run models like through the Great Depression, through 2008 and all the economic downturn, and it still performs well. It's crazy. So
Can you spell his last name for us, please?
Nowicz. I think that's it, right?
Thank you.
Yeah. Yeah, that's it. Yeah, that's it. Okay. So, all right. Well, thank you, everybody. Thank you, Lisa.
Yeah, thank you, Mike. This was great. I feel like this could go on for hours. So
I know. Thank you guys both so much.
I think you guys would all fall asleep soon. So.
Nope, not me. Sorry if I monopolized it all.
no, all great questions. You helped all of us, Terry. So all good stuff.
Great.
Oh, great.
All right.
Thank
Well,
you
thank
very
you guys
much.
so much.
You guys have a great rest of your day.
You
All
too.
right, you too. Bye-bye.
Bye.
Bye.
Thank you.